Hi, I'm Scott Humphrey, CEO of the WFCA. Thank you for joining us for this, our fourth webinar Zoom conference since the onset of the coronavirus, as we seek to keep you updated on everything that's going on and make sure you're aware of what you need to do, your calls to action to take advantage of everything that's being done for you at the state and at the federal level. Today, as we go through this webinar, will probably take about an hour. That really will be determined by your questions and our subject matter experts' responses to that. But we ask that if you have a question that comes up after the overview presentations are made, please post that down in the chat area. I'll take that information and deliver it to either Steve or Jeff as we go through to make sure that we get as many responses as we can. Now, we may not cover all of them during our time together. We don't always have that opportunity. If we do not, we'll seek to answer the questions later, and you will find them at the WFCA.org website. We have changed the website so that you can see very clearly everything that's going on, specifically related to the coronavirus. We have a coronavirus response page. Click on there. It has a whole plethora of information for you, information about loans, about family leave, about insurance, about state-by-state guidelines, who can work, who can't work. We even have a page on there for our brothers and sisters to the north in Canada, as we're trying to keep you up to date on what's going on from your country's standpoint as well. Before I turn it over to Steve Abernathy, the CFO of the WFCA, I just want to give you an update on some of the things that we've been doing to try to keep you attuned. Again, the best thing you can do is go to the WFCA.org website. That website has everything that we believe you need, including a page where Jeff King, our legal counsel, has responded to your specific questions. And so we post a whole list of those questions. Very likely the question you have has already been answered. If not, certainly you can respond back to us, let us know what your questions are, and we will continue to keep you updated through what's going on with our lobbying partner, Lobbyit, in Washington, D.C. In addition to changing our website, this is probably, I think, our fourth Zoom conference. We plan on having these weekly, as long as there is a need. A lot of information has changed. You'll notice that in the conference today, we won't be covering a whole lot of the things that we covered before. We think you're up to date on that. There's a lot of information out there from other associations in our association. This webinar will be different because we're focused on new questions that are coming to you based on the latest changes that are taking place, again, at a state and federal level. You have access now to our online university, and we are making the online university. We had already made that free for our members through the end of April. That will now be through the end of June. So through the mid-year point, you'll be able to access the WFCA University online at no cost if you're a member of the WFCA. Remember, membership in the WFCA is free. It costs you nothing at the primary level. So if you're a professional flooring dealer, then your membership is free. Our associate members still pay. They get benefits that have a very high monetary value to them. But for the primary members, your membership is free, and now you have free access to the university as well. I want to introduce to you Steve Abernathy. Some of you have seen him on the previous webinars. Steve is the CFO of the WFCA. He spent over 30 years at Shaw Industries, where I spent 25 years. We worked together there. Steve has served with us for over 5 years. Steve has a very good insight into both the financial markets, but also the HR component of what's going on with this. And so we asked Steve today to address some of the other questions that have come up. We have some partners that have joined us on this call and sent us some specific questions. I think you'll find many of them answered, and you'll see some changes in what Jeff is talking to you about as well. But Steve, if you'll take it for just a moment, go through your slides, and then if we have some questions, I'll try to direct those specifically to you.
Sure. Thank you, Scott. Good morning, everyone. Thanks for joining us on the conference today. I'm not going to go through what I did on the previous two seminars. We do have, as Scott said, those are recorded and they're posted, as well as our slides that we have are posted on our website at WFCA.org. I'll just give you a quick market recap. I do that generally at the start of each of these, but I'm not going to go through the slides as I've done before. Essentially, not much has changed since our last conference or our last webinar. The markets have sort of stabilized here at about a 50% retracement of the decline that we had from the very beginning of the crisis. It has recovered about half of its value, which is very nice. At least it helps sort of settle the markets down and settle folks down that are really panicking over the losses that were incurred there at the low that we experienced a few weeks back. but at least they've settled down. They seem to be sort of awaiting what the future direction is going to be. And I know there's a lot of things that'll be coming out here over the next few weeks as to how we get the economy back started again and how we get things moving again. And that will certainly have some impact on the market as well, as we go forward. So again, if you want to see some of the slides that I had previously, I looked at the precedent for what we're going through. This is not something that is unusual for us. It doesn't happen frequently at the depth and speed that we've seen it happen, but it has happened before where we've taken large downturns, both economically and in the financial markets, and it's not unprecedented whatsoever. What is true for all of those other declines is that we've recovered, and we look for that time when we'll start the move back up. And I don't know when it'll come, but when it does, we want to be ready for that and have our businesses positioned for that going forward. So I'm going to take you through a few things more related to the CARES Act today, and Jeff's going to elaborate on several more issues that are out there in regards to some of these HR issues. So we'll kind of tag team that today. So Lewis, if you would show the slides. I'm going to look at particularly here. Go ahead and go to the second slide if you would. I'm going to look at particularly here the things that are impacting in the CARES Act, the 401k plans and IRAs of individuals. And specifically, I'm going to look at 4 provisions in the CARES Act, the first of which is the coronavirus-related hardship distribution. This is a new distribution that has been put in place, and I'll go through the details of that, who's eligible for that, how that goes in terms of your plans. Also, looking at the 401k loans. Loan options for 401k plans, they have increased the limits on that and set some parameters around that. And I'm also going to talk about R&Ds, required minimum distributions, and then finally the IRA contribution deadlines that have changed with the coronavirus CARES Act that has been implemented. Okay, next slide. So the coronavirus hardship distribution, this is a new distribution allowance for any qualified plan, 402C, 8B sections of the code. That's the 401ks, 403Bs, all of those different plans. IRAs are all considered part of those qualified plans, with the exception of the Roth IRA. That is not a qualified plan. So other than that, these hardship-related distributions are going to apply to any retirement plan under that section of the IRS code. The CARES Act basically defined the eligibility for that, though, specifically to those that have had or have been impacted by this coronavirus in some way. And so eligibility for this new hardship distribution, and this is a distribution, not the loan. We'll talk about the loan here in a minute. But under the distributions, an eligible individual is one who is either diagnosed with COVID-19, and that is with an approved test by the CDC, whose spouse or dependent is diagnosed with COVID-19, or who experiences financial consequences as a result of quarantine, furlough, laid off, reduced hours, or unable to work due to lack of childcare. So there's some very specific eligibility requirements. You must be impacted by the coronavirus for this particular hardship distribution. Now, those plans already have hardship distribution rules. This is in addition to that, and this is a separate clause for specifically related to coronavirus. Next slide. So the key provisions of that is there's some benefits to it that they've added in regards to this coronavirus pandemic. One is the waiver of the 10% penalty for eligible distributions up to $100,000 for 2020. So under normal circumstances, even hardship distributions have a 10% penalty that the contributor must pay in order to take a distribution from a qualified plan. That penalty is waived for eligible distributions under this coronavirus clause. And it's up to $100,000 in aggregate across all of those qualified plans for an individual. The income recognition on that, however, is still there. You don't pay the 10% penalty, but you must recognize it as ordinary income on your tax returns. However, one of the things that they've done is they've allowed you to spread that recognition out over a 3-year period. And so you don't have to recognize it all at once. Even though you may take the distribution in 2020, you're allowed to carry that forward in terms of spreading that out over a 3-year period so it doesn't hit you all at once. on your taxes. Again, no penalty, but you do have to recognize it as ordinary income, and it would be taxed at your rate that your other income would be. They also allow for a recontribution, however, of those funds back into a qualified plan anytime over a 3-year period. If you do that, you can avoid the taxes on that distribution. So that's a different sort of a new thing there, where they allow you to put the money back in over a 3-year period that you've taken in distribution, and avoiding the taxes on that. Now, all of this related to the hardship distribution requires that for 401ks, particularly, the sponsors must amend their plans to make it available. It's not automatically available in all cases. Some plan sponsors have given deadlines as to, what their, or excuse me, some TPAs and administrators have given sponsors deadlines as to when they must amend their plan, but it must be amended. It's not an automatic thing. So if you have a 401k plan, for example, for your employees, and you want to make this hardship distribution available, you need to amend your summary plan description, your plan documents, to allow for that. It's not an automatic. So just keep that in mind. Again, this is the hardship distribution related specifically to coronavirus from qualified plans. Next slide. So the other thing that has happened is they have increased the 401k loan limits. So if your plan has a loan provision in it, your 401k plan for your organization has a loan clause in it, then it would be eligible for, if you make, again, you have to make a change to it. But they're allowing now an increase in loan limits related to this coronavirus. But again, the eligibility of that is an individual who has experienced an impact due to coronavirus. So once again, someone that is diagnosed with COVID-19, a spouse or dependent that is diagnosed with COVID-19, or an experience of financial consequences as a result of a quarantine, furlough, layoff, reduced work hours, or unable to work due to lack of childcare. So the same requirements on the hardship distribution apply to the 401k new loan limits that have been increased for this purpose as well. So next slide. The key provisions of this loan is that, number one, it's only for plans that have loan provisions, and sponsors must, again, amend their plans. The plan documents must have those clauses in them. And so if you, again, want to offer this capability, you must amend your 401k plan to allow it. The participants can borrow the lesser of $100,000 or 100% of their vested balance. That's quite different than we have on normal 401k loans today. That limit is generally $50,000 or half of your vested balance, whichever is less. This changes that, and this is a specific loan clause related to the coronavirus. It's totally separate from that. And so the borrower can borrow up to $100,000 or 100% of their vested balance from this 401k limit, once again, if sponsors amend their plans. Next slide. Another provision of the CARES Act related to qualified plans is that there is a change in the required minimum distributions for retirees and those that are eligible or required to take minimum required distributions out of their qualified plans for 2020. The key provisions of that is it applies to individuals, again, that are required to do that. If you're over, I believe the law got changed to 72, if I'm not mistaken, 72 years or older, or it was 70 and a half, I believe, before that. The decision not to take a required minimum distribution does not have to be coronavirus related. Unlike the other two provisions that I just mentioned, this does not require you to have a coronavirus related impact for you to not take an RMD for 2020. It really is a result of the fact that the markets have pulled back so hard that I believe that they recognize the fact that to force required distributions right now would be to force retirees to cash in potentially in a time where the market has pulled back substantially. And so they recognize that, and they eliminated that required minimum distribution for 2020. You can also recontribute to an RMD that you've already taken within 60 days of distribution. So if you took an RMD, for example, from an IRA, a standard IRA, traditional IRA, prior to this legislation being enacted, you can recontribute within 60 days that back to that plan without penalty and without tax implications. You simply can put the money back in. So that will help those that have already took their RMD at the first of the year, for example. Next slide. And then finally, one other provision there of the CARES that relates to qualified plans is that they have extended the contribution deadline for IRAs, both Roth and traditional, to July 15th, 2020. And so if you want to contribute for 2019, you will have until July the 15th of 2020 to do so. So that's just some of the provisions in the CARES Act that are related to the 401ks and IRAs and all the qualified plans that are out there for retirement benefits. Okay, that's all I got.
Great. Steve, thank you. Just for clarification, I think everybody knows this, but just quickly explain the difference between a distribution, which is funding that you have already input, and a loan.
So a distribution is actually withdrawing the funds out of the plan permanently. It's actually a cashing in, if you would, of the funds that you have in your 401k or your IRA. A loan provision is different than that. You're technically borrowing from the plan, from your balance, invested balance in the plan. You're borrowing that money, and that money has to be paid back over a period of time. It's generally paid back over a 5-year period of time. With interest, there's an interest based on your plan and how that plan is defined. There's an interest that you pay back. However, the thing about a loan is that you're paying the interest back to yourself. It is essentially works that way in most cases. So a loan is a borrowing from the fund. A distribution is a taking from the fund with no intent to put it back in. However, as I said, under this particular hardship distribution rule, you can put it back in over 3 years, within 3 years, and not have to pay the income taxes on it. So that's kind of the way that goes. On a loan, there's no income tax implication as long as it is paid back in a timely manner. With interest, you pay that back into the fund and you really don't have a tax implication. The deal with a loan is, in a 401k, is that if you leave the company that 401k plan is with, that loan becomes due and payable. And if you're not able to pay that back after leaving the company, it becomes a taxable event for you with penalties. So just be careful with that. Talk to your TPA on how to properly execute that if that's something that you want to put in your plan.
Great. Thank you, Steve. All right, we're going to get to Jeff King. Jeff is the busiest legal counsel in the flooring industry. There's no doubt. He has been responding nonstop since the coronavirus thing came out to individual questions and beyond. Let me just go ahead and let you know in advance, Jeff is not licensed, obviously, to practice in all 50 states or north of the border. He simply gives you his advice. He does research to find out what's going on at the state and the federal level. He is in constant contact with our lobbying firm, Lobby It in Washington, D.C., and Jeff practiced in D.C., so he has great relationships there as well. And so he does give us an inside look at what's going on, but then takes that information and then translates it to a level that you can understand it, and then go to your professionals on your team, your accountants, your lawyers, to find out how you need to respond. So we'll give you the 30,000-foot view, and oftentimes Jeff dives even deeper than that. But his advice is simply that, it's advice, and you decide how you're going to move on that advice. Jeff has prepared a slideshow. He'll go through that, and then if you've got questions, we've already got several that have come in, we'll get Jeff to respond to those questions. Jeff, take it away.
Thank you, Scott. If you looked at the notice, you realize that Zoom must add 10 years to you, because the picture is really not quite what I anticipated. Let's just jump right into the slides. Can we start with the first one? Okay, thank you. What we're going to provide today is just, this is a weekly update. I'm available during the call, after the call, to fully answer any questions about anything we've discussed in the previous webinars on the nitty-gritty of what's going on here and some of the programs. But I want to give you an overview just to make sure you're aware of all the opportunities and responsibilities you may have during this pandemic. Next slide, Louis. There are loans and grants out there. We all talk about the CARES Act, and the three main provisions of that are the Forgivable Small Business PPP loans, and we've gone through all the responsibilities and how to calculate those. I understand there's a lot of frustration with it. Those of you who have had banking relations, have had them on, we've heard that it's a 13-day process, a 15-day process from the time of applying, if the bank's capable of taking it in, to actually receiving the money. And we've had several members mention that. The problem we're having is that for smaller members, the real problem evolves is that there are not, if they don't have a big time relationship with their bank, they may not be able to get these processed. Banks have simply shut down anybody but some of their most cherished customers. You also have the employee retention tax credit. It's an alternative to the PP loan, and it basically allows you to take a tax credit on what you pay your employees during this time period. And you have these emergency small business loans and grants. Those are the ones where you can get an initial $10,000 that doesn't have to be paid back if the loan is not given. There are other loan programs out there under the Small Business Administration as well. You should be aware of those. They may provide you with some very quick and short-term money. There's Express Bridge Loan. If you've had a relationship with small business earlier, you may be able to get a quick $25,000. It's a lot less paperwork and it's quicker. If you're a government contractor, there are special loans for you. And if you have certain capital needs, there's loans there as well. So looking at what you need to be aware of all these loans. Next slide, Lewis. But the federal government's not the only place that are giving out loans and grants. States are doing it. I've listed a few here that have these loans. But you also have many cities and counties that are giving out loan programs, anywhere from $5,000 to $25,000 grants or loans done. The website I have here actually will list each state and what loans, programs, and grants are out there. You can also just contact your governor's office. They'll direct you where to look for these business loans and programs that are being done, okay? Or you can contact your city or county managers and they'll do the same. And Steve went through the access to your retirement accounts. That is, again, another possibility to get you through this crisis. You can actually borrow up to $100,000 out of your loan, your retirement account, if you have $100,000 in it. If you have less than that, you can borrow all of it for the moment. So that's always been very restrictive in the past. It's not now. Next slide, Lewis. I want us all to go back and remember about the Families First Act. That's where you had to provide sick and family leave in very limited circumstances. And as we know, the Department of Labor came out and said, you don't have to provide it if you don't have work for your people. That has been a bit controversial, but the big issue on that is that we're now going to start seeing some of these shelter orders eased or removed. And your people are going to come back on. And as you hire them back on, this leave program is still in effect till July 30th. Excuse me, June 30th. That means if you have somebody come back on and they can't come back on because a doctor's ordered them to stay home, they're sick and are trying to seek a diagnosis, they're caring for a sick family member, or they're caring for children because there's no school or daycare. And by the way, school is going to continue to be closed in most of these shelter-in-place states. You still have to pay that if they can't work and you have the work for them. Next slide. The same applies to the 12-week family leave. It only applies to children, taking care of children. The first 2 weeks are without pay. The reality is the first 2 weeks will then be actually covered by the sick leave. The next 10 weeks will be covered by the family leave. There is an exception possible. It's self-determining, but you're not to keep documents to prove that your cash flow is so severe that it jeopardizes the continuation of your business. But be careful. First, the interpretation that you have to have work for people has been challenged. New York Attorney General has challenged that. So we'll need to keep you advised, and you need to keep alert that if any of these things change, you need to be aware that you may have to come back in and start to provide this leave. And you cannot discriminate. The EEOC has come out with rules. You cannot discriminate. You can't say, I'm going to bring back these 4 people because they don't have children, so I don't have to pay the leave. You can't do that. You cannot discriminate against people for that reason. Next slide, Lewis. I want to talk about unemployment benefits because you may, as actually store owners, have a right to these if you're closed down. There's the pandemic unemployment assistance, and that expands coverage to people that are normally not covered. So self-employed, independent contractors that generally don't get this coverage can get it. The next is the federal pandemic unemployment compensation program. That adds the extra $600 per week on top of what your state normally will pay, and an extra 13 weeks of state benefits. These are all funded by the federal government. My understanding is all states have agreed to the program since this is a state-run program. My bottom line is if you don't know whether you apply for it, but you have been financially hurt, you're not working full-time, you're not getting your wages, you can't pay yourselves, apply. This website here will give you all the information on a state-by-state where you apply for it, who you contact, and how you determine it. But you may actually be able to collect unemployment. It's for most states, it's 26 weeks plus the 13 weeks, which is 39 weeks. For most states, it's half of your income plus the $600. So consider that if you are working part-time and paying yourself part-time, or your employees are. They also, in most states, can get public assistance. They just get a deduction. A portion of their public assistance will be deducted for the pay they get. So be aware of that. Next slide, Louis. Legislative and regulatory action. There is a new aid package. It's being stalled in Congress over medical aid. There's a big issue about providing assistance to states for the medical coverage they have. And there's some other aspects of the bill that's being fought. The bill in the Senate does not appear to be going anywhere, but the House is writing a brand new bill. Both bills had included an additional $250 billion for PPP loans. We're hoping early May we'll see this because the PPP loan money is running out. I've been told that in the last 15 days, small business and banks have written more loans than they have in the last 5 years combined. Okay. Business interruption insurance. There is state legislation we have put out, and we urge you to go on WSA's website and join that grassroots campaign. It's the easiest thing to do. You hop on that site. It'll tell you if your state already has a bill. You click on that state. You type in your address, it automatically fills in your governor's name, your local representative's names, and allows you to send out an email urging them to pass this legislation. If you're not in one of those 5 or 6 states, you put on the other general state thing, it does the same thing. That letter, however, urges them to consider this legislation. Again, automatically type in your address. You can type in your home address, which is probably where your legislative representative is. And you can, from that point, have everything filled out and automatically sent out by hitting a button. There is federal legislation as well. By the way, the state legislation is saying insurance companies must cover business interruption caused by the COVID-19 pandemic. There's federal legislation saying the same thing. The federal legislation is a little easier because they're going to pay the insurance companies to cover this. I think that ultimately will possibly get passed, particularly if states start mandating coverage. There's also been class action suits already covered mandating that business interruption insurance cover it. We've covered some of this in the past. The big argument is this. Many of your policies will have a pandemic exception. They don't cover business interruption by exception. Only covers damage to your property. Increasingly, courts have held that if you have an infectious disease or you have a chemical spill, that damages your property, even though it's not directly, it's the building next to you or something, because it renders your building unsafe to be in. And so that's where the issue comes in. So file your claims, get them going, and join the grassroots campaign. Maybe we can get you some money down the line that will help make up for these tremendous losses you are suffering at the moment. Next slide. Business obligations. Don't forget you're still in business, even if you're not running a business, even if you're not going in every day. Line of credit and other loans. You may have to notice of material changes in your loan. And you have had some material changes if you're shut down or barely operating. There are covenants, there are ratios in your loan. Make sure you deal with this. The federal regulations have been issued that say you can restructure these loans, which generally are very difficult to do, based upon the pandemic issues. So in other words, they're not requiring these restructurings, which these, by the way, these loans are often federally guaranteed through various banking regulations, that the banks have to create certain ratios in order to be covered by their banking laws and their own insurance. And they're saying you can restructure these loans beyond those normal requirements. And generally, you can't restructure a loan if it's over 30 days late under federal rules. They're saying the 30 days, it still means it's current. So it's time now to review your loans and your lines of credit and make sure you're current in everything and get any changes you need to be done. You also have contracts, outstanding contracts. There are force majeure clauses. They're strictly read. They may or may not cover the pandemic. There are other aspects. There's called the doctrine of impossibility, frustration of purpose, and impracticability. You may have a right not to comply with contracts, but you at least need to communicate to your people with whom you have contracts, whether they're a supplier or one of your customers. And make sure you don't forget to renew your insurance. Because we're trying to get you business insurance, interruption insurance. We sure as heck don't want you to lose your coverage simply because you haven't paid your bill or any of that aspect. This is fairly important coverage, okay? Next slide. You have obligations to employees as well. If you're 20 or more, have 20 more employees, you have COBRA obligations. Unless you have continued their health, if you provide health care, and unless you've continued it, you have to give them a notice and an opportunity for them to buy that insurance in your plan. It's for 18 months after they've been furloughed, laid off, or terminated. And the employee pays basically 102% of the premium. The 2% is for your overseeing the process and such. There are state COBRA laws as well, so be careful. If you're under 20 lawyers, the state laws usually require a shorter period of time, maybe 6 months, and I've seen it as small as 5 employees cover under the states. So be aware that if you're letting people go and do offer health insurance and have not continued it, you have some obligations under the federal and state COBRA laws. Don't forget to do these because the penalties are severe. Next slide. Also, a number of states have advance notice of reduced pay. So if you're reducing people's pay, you have to give advance notice. Most of them are usually like one pay period, like a week, one pay period. But you can't just reduce the pay retroactively or any of those aspects. A number of states have these. District of Columbia has them, and certain localities require it. Be very careful when you reduce these that you've given the proper notice. You go on the website and just on your browser, type in advance notice of reduced pay and type in your state, and it'll tell you whether you have an obligation or not. And don't forget exempt employees. Salary for exempt employees are not dependent on hours worked. So if you reduced hours worked, you don't get to reduce their pay because then they're not an exempt employee because they're a fixed salary. If you do reduce the employee based upon an agreement with them that you're reducing it, be aware that if the minimum wage, in order to be exempt, goes below $913 a week, then they become eligible for overtime. It's going to be harder to pull them back in once this thing is over. So be very careful what you do with your exempt employees. If you lay them off entirely or furlough them, that's fine. But if you reduce their hours, you may be setting yourself up for later problems. So please be careful of this. Next slide. That's it. There's a bunch of other things we can cover as well, but I wanted to give you at least this brief overview of some of these ideas and concepts that you need to be following.
All right, Jeff, thank you. Steve, I'm going to go back to you first because we had a question on 401k that was given, and then I'll go back to Jeff because I think there'll be other questions that come up. Greg Bestman has asked, 401k loans typically have to be paid back fairly soon and are typically tied to a payroll deduction. Is there a delay or different rules or delay set up for COVID-19 loan payback? You mentioned that briefly in the presentation. Just reiterate if you would. You're muted.
The normal 401k loan is paid back over 5 years. Typically, that's the way they work. And this would be a 5-year loan too, as far as I'm aware. I don't know of anything that changed in terms of the loan payback period, other than the fact that they did give, for any payments that are due in 2020, they've given a 1-year delay in that. So essentially, they've given you a 1-year reprieve. And And I believe that applies, Jeff, you might know particularly, I believe that applies both to existing loans and also this new coronavirus loan, hardship loan, that would be taken out of your 401k. They've given you a 1-year reprieve for anything that is due in 2020. I haven't seen a lot of clarification on how to implement that, but I do know that that was part of the provision of the CARES Act, was that 1-year delay.
Steve and folks, you're quite right. It is unclear. But these statutes were written with such haste. There's a lot of inconsistencies in them that create a bunch of problems and issues for us all. What I will tell you is this, is that I believe the 1-year delay is on existing loans for sure. I'm not sure how it applies to Corona loans since you're only beginning it this time. Does that make it 6 years, or does it make it still the 5-year rule? My instinct is it's still a 5-year rule, but if you have an existing loan that is due this year, for example, your last payment is due this year, you have to pay it by this year, you get an extra year on it. That's how I read the statute. Is that consistent with your understanding, Steve?
Yeah, it's very unclear. I read it about 15 times trying to figure out what the language was on it. And it's very confusing. Hopefully they'll either issue clarification on that, or we'll be able to get some clarification on it. But I do know for a fact, you're correct. Existing loans that have payments due in 2020 are deferred for a year. You can get those deferred for a year. Whether or not the coronavirus specific loans are going to be a year delay before payments are made, that part is definitely unclear. I will tell you this also, those are generally paid back through payroll deduction on both cases, that they would come back through a payroll deduction as a way to repay those loans.
Just be aware, however, if you're operating as a LLC, then you can pay that loan back through you're the owner or you're in a partnership or sole proprietor. Those loans you pay back without payroll deductions. You just have the 5-year mandate to do it. And remember, interest does run on them. It's why you're paying yourself interest, but interest does run, and it has to be a fair market value interest on it. It can't be something 0.001%.
Sure. And again, on 401ks, most of your plan documents define how that is. Generally, it's 2% over prime or something along those lines that they do it with.
All right, good. We'll move on. Jeff, the first question came from Eddie Duffy. He says, a company who will or has received a CARES PPP program loan that has full-time employees who perform a large percentage of their work on overtime hours along with overtime wages. When they're providing the weekly wages under the stimulus, do they use the 40 regular hour wages, the regular 40-hour week, or the average hourly wage based on their previous year, which may have included overtime as well?
Let me just go back through each piece of it, Eddie. The reality is that you're correct that when you add up how much you paid them, you use all wages, including overtime. So the amount that you're going to multiply by 2.5 includes regular wages and overtime. When you pay it back, if they're only working the 40 hours or they're not working at all, you simply are paying this to them to keep under the loan. You can pay them back at the 40 regular hours. The problem is going to be, remember, 75% of that loan must be used on wages. So if you pay back their current wages, and that only accounts for 50% of the loan usage, then you're going to have that portion of the loan unforgivable. It's not going to be forgiven. It's going to retain a loan, and you have 2 years to pay that portion of it back. So you would have 75% of the loan forgive, 50% for wages, 25% for other items, assuming you spent them on the other items. And the other 25% that you didn't use on wages would fall into a loan that would have to be paid back within 2 years at a 1% interest rate.
All right. Jeff, this is from Mark Weaver. He said, we received our funding and the date on our loan documents was the same day on the 15th of the month. Can we use our payroll paid that same day as the starting point for the forgivable part of the loan?
Yeah, it's the origination. It's the origination of the loan that matters. So the answer is that they've really not defined origination. Generally, origination is application, but I think in this I think they mean when the loan is given. So if you got the loan today, you can use it today to pay your payroll for the next 8 weeks.
Yeah, so guys, one of the things I want you to understand is there is so much fluidity in this, not only in our interpretation, but often when the legislation is voted on, they're still working out details long after it's been voted and approved. And that's why you'll see us not only sending the initial communication, but also updating you on the same thing, cares, family leave, all of those things you see multiple communications on, because they're still working out the details on the backside. Jeff, you might speak to a moment about the extension of these loans. I know you mentioned it in your overview there, but there is some conversation going on right now about how much that additional funding might go in. Do we have any idea on time frame on that?
My understanding is that there's been a lot of concern about the PPP loans. Number one is that when they created these loans, they wanted to create an easier system so that more banks could offer them and be quickly in it. The problem is they didn't eliminate all the regulations, which means the bank is still vouching for the individual's credibility, creditworthiness. And that's a mandate under the Small Business Loan Program, and they didn't take that away. That's one of the reasons banks have only gone to their base business. If you want to, Bank of America wrote, I think, $21 billion of loans in the first day, but only to their existing customers. Wells Fargo, same thing. They only go to existing customers, and Wells Fargo has cut that even out. They don't want to take any more loan obligations on. That's why you're having a problem if you're smaller and don't have a relationship with what is called a 7A bank, a small business 7A bank. And that means they've already been pre-approved for the loans. And it's why new institutions coming in are having a problem, because there's still these regulatory obstacles about credibility and creditworthiness. So that's created a problem. Unfortunately, that means that people who may need it the most, the mom and pop shops, your neighborhood restaurant, to be quite honest with you, or bar, where they're completely closed down, that don't have those deep relationships with their bank. They may not have a big line of credit. They may not need a line of credit. They work on a cash basis, and they don't borrow. They're going to have a problem getting a loan, yet they're the ones who need it the most. And that's being debated right now. There's a lot of service industries, from small law firms to accounting firms, that have taken advantage of these loans, which really haven't had the kind of impact on them because it's free money. So be cognizant of that. That's part of what the problem is, along with some other funding, which relates to state health care costs, etc. I believe the House is now writing a new bill that will take into account some of these factors. But both the House and the Senate bill have both, as I understand it, included $250 billion in additional funding for the loan, on top of the $3+ billion that have 300 and some billion that have already been done. Even that may be proven to be inadequate. And subsequently, when we start to slowly re-engage, you're going to have to find, there's going to have to be some stimulus packages to get people to spend again. This may be a permanent shift in how we shop and how we do things. Construction industry, I think, may have a real boom. You guys may be wonderful off after this, but I don't know. And so there's going to be a lot of legislation going on over the next 6 months to 18 months to deal with both the ramifications of and the after effects of this pandemic.
Jeff, I saw some communication. I was following on one of the news networks, and somebody was asking, do you apply for the PPP loan if you don't think you need it? And you just referenced that. That's the reason I come up with this. The response was, yes, apply, because you might need it later. You may not need it right now, but this senator actually said there's a pretty good chance you will need it later, so it doesn't hurt to go ahead and apply. I know there are people that feel like they're taking the high road by not applying. I just wonder if you could speak to that for just a moment.
Yeah, I mean, the answer is there are some states, particularly our more rural states, that have not been hit hard by the pandemic, okay? I grew up in a very rural area in upstate New York. You talk about social distancing, we couldn't see the farm next door to us. There's several hundred acres of dairy farms, and everybody has that. The reality is we're starting to see that county get hit right now, and they're going to start looking at whether they need to shut things down. And all of a sudden, those people didn't think, I don't need the loan. We're booming away. All of a sudden, we'll need it. Yeah. The answer is that it's attempting free money. there is a moral aspect. I struggle with the same thing. I've had a reduction in my income because of all of this. I can't charge clients. I have clients that I've done more work for than I ever did, and they don't have the money to pay it. And I've simply given it to them because of the urgency and the need of that, including this client, WFCA. So it's hit me, but it's not like I'm bankrupt today. It's not like I have no income coming in. And so those are the kinds of moral aspects that are difficult. On the other hand, it's pretty hard to give away $20,000 that they're going to just give me back for free. So those are the struggles you have. But the answer is that I don't know when this will hit you. If you're in areas that have shelter-in-place laws, whether they're by state or by county or city, you need this. You will eventually find yourself possibly in this. A prediction is 1 in 2 Americans will be infected with COVID-19 before this is all over. Whether you're sick from it is a different issue, but 1 in 2 will have this infection.
Yeah, and I think part of my fear is, Jeff, that people that think they don't have to apply, by the time they realize they do, the funding's not there for it anymore. Right? I just think we probably encourage people to, if you have the opportunity to apply, be realistic in your need and apply. Here's a question.
That's already true. We're almost out of the first $300+ billion. So we're the small businesses average $21 billion a year in small business loans. They've already given out over $210 billion already.
Yeah. I think I heard 300 billion this morning, and they were right around that mark.
Yeah, they're getting close to that. You can see how much they've written in the past. 15 years or so.
We've got a couple of other questions that have come in. Sarah Patrick asked, has anyone been able to determine how members of an LLC who are not technically employees of a business but pay payroll taxes through Schedule SE are supposed to fill out these forms? Do they apply through their business entity, or do they apply as individuals?
If you're an LLC, you're considered self-employed. You can apply through your business entity, but your payroll does not include you as a rule. Unless you have yourself set up as payroll, you will not have, you personally pay your payroll taxes. But as I read the rules, you don't get to include those in. You get to include your salary in up to $100,000 or your payments you make to yourself. But you don't, and your employees, you get to count everything you charge for. But unless you're actually paying the payroll taxes on a weekly basis, my understanding is that the way I read the rule, and this is completely unclear, is it's not, and that's something you need to deal with your bank on, ask them as well, see how they're accepting the loan and what they're including in it, because they're making interpretations as well. But so far, self-employment taxes, which is you pay both the employer and the employee share of them, essentially as an LLC and a self-employed individual, do not appear to be covered, because what they cover for independent contractors, sole proprietors, and the self-employed is your 1099s, they said. Okay. And so that seems only your income is included.
Okay. Next question is from Richard Velo. He says, is the 1% interest forgiven on the PPP loan if used for appropriate cost? If you don't have to start paying back for 6 months, is the interest compounded from the date of origination?
The answer is no, it's not forgiven. So you actually may owe an interest at the very end of this thing. 2 is that I don't believe it is compounded. I think it's a straight interest based upon the loan amount. I don't think they compound it. They don't have normal small business loans, so I don't know if they do on this. There's nothing in the regs or the rules on it, and I'd have to go back through the small business regulations, which are would make Tolstoy's War and Peace look like it was a small book to figure that out.
Yeah. Hey, Scott.
Yeah, Jeff.
Just one of the things, I want to go back to the question that Jeff was answering earlier on the self-employed. And again, I think a lot of it is again, very unclear. It's very hard to nail it all down. Jeff, I have seen some things on the self-employed that if you're self-employed, you're generally filing a Schedule C, right, on your taxes. and that the calculation for a self-employed without employees, in other words, if you're running a business without employees, it's just you, is that you take your net self-employment income subject to the SE taxes, and that is the value that you use. You take the annual divided by 12, multiply it times 2.5. Is that what you've seen on that? You take the self-employment, in other words, all the total of your Schedule C's self-employment.
It's not clear. It's not clear because if you read the actual law, it says for the self-employed, independent contractor, and sole proprietor, that's the phrases they use, you take the 1099s. And they're assuming they're sole proprietors, all of them. And that's the problem with it. So they take the total 1099. And that captures all that. And if you're a sole proprietor and you have $90,000 in 1099s, that captures everything. That actually captures all your overhead as well, technically, because you're paying all of that. They allow you to include everything in it. If you're an LLC that has employees, it becomes more complicated. And that's what's not been clarified. We've asked for clarification for that under the rules.
All right, a couple more questions. Here's a couple that have had challenges with their banks. I'm gonna read the first one from Terrell Williams. It says, I applied the first day Bank of America set up their special online application on April 3rd. I'm currently in step 2, but I'm still waiting on a loan officer to contact me. I have been a Bank of America customer for 17 years with a line of credit that is current, acknowledging that they will switch banks after this is all over, but should they try to switch now and reapply?
No. You're not going to find another bank that can help you. At least your application is in. I would bug the bank daily. Ask for an update where you are. Just, the squeaky wheel gets the most grease concept. You just got to find out. You can do it by phone. I do it by email. I like emails just because they leave a track record. But it's a first come, first served basis. Why Bank of America has not processed all of these, I cannot tell you. I do know in the beginning, they didn't process any of them initially because there was so much confusion about what had to be done.
Well, and Jeff, the next question is from Dave Jones, and it might actually answer that question because he says that they've banked with Wells Fargo for years and that they feel like they got yanked around trying to apply for the PPP loan. They kept pushing them out for the application. He said, we finally found a local credit union that would accept application from us, even though we had no prior relationship. That's rare, as you mentioned, but they found one. They processed our application quickly and we got preliminary approval, but they just notified us that the $350 billion has run out before we could get funding. Is there hope that more money is coming? I know we've already said that, but yes, there's up to $250 billion more that it looks like will be voted on soon. It looks like they're getting pretty close. In fact, I just followed a news item that said that both the Republican and Democratic sides were very close on that.
But the House isn't coming back in session until the beginning of May. So there could be a couple of weeks more to go. I just don't know, but they'll work that out. They've been pretty good with working with the White House to find these, they put together 3 bills with negotiating with Secretary Mnuchin, and it was just they did a good job doing it. Not all to the delight of the Senate, but they did a good job getting these things through fairly effectively. So I suspect this will happen again. Credit unions, actually, I should have mentioned that, have actually been pretty good about this. An awful lot of credit unions are small business 7A banks, meaning they are pre-approved for these kinds of loans. So that's something to look at. If you have any credit union contacts, it's one of the best places to go to. But you can't apply for 2 loans, so you can check with your local credit union or a local bank to see if they're able to process it. But we knew this money was running out quickly.
Okay, Jeff, another question from Mark Weaver. In addition to rent and utilities, can we include, I'm assuming he's capitalized already, I believe that's real estate taxes toward our 25% PPP expense?
That's not one of its utilities, rent, interest on mortgage and loans. Nothing else is allowed into that.
Okay, they're very specific on that.
Yes.
Okay, all right. Guys, I'll give a few moments for any additional questions that might come in. Let me remind you, everything that has been said here today. This is being recorded. Lewis Davis, who handles FCB2B for us, is also monitoring this for us, and we'll be posting this to our website, wfca.org, later today, so that you'll have access to all of this information, responses to the questions, etc. Okay, another question just came in. Can we wait to rehire all employees to start working the Monday after receiving the loan proceeds to start our 8-week forgiveness period? This will ease the financial cash flow burden while waiting for loan proceeds.
If you read the statute, the answer is yes. If you read the regulations, the answer is no. And so SBA is administering this program. The answer is that the 8 weeks start on the origination of the loan. So the day you get the loan is the day you have to start paying them for. You don't have to bring them back on. Remember, if you have no work for them, they don't have to willy-nilly come into the office. This is sort of like an unemployment program, insurance program. It's just an alternative to it. They're saying, we're going to give you money so you can keep your employees happy. So when this thing passes, you kept those employees happy. You worked with them, you got them money, you borrowed this money to get for them. You're paying them regular wages. You're trying to keep your business afloat, and they're an important part of it. So the idea here was not to make sure employees came back, particularly if you're under quarantine orders or there's still risks in your area, or you simply don't have the business at the moment because of those risks in your area. All they want to do is see them paid. Start the payroll period immediately upon the origination of the loan, and from that point forward, count the 8 weeks. When the 8 weeks are done, that's when the loan is paid. Submit for your add up what you paid in utilities, your lease, any mortgage interest, and business loan interest. Add it up and submit it for as soon as you can to have the loan forgiven.
Okay, a couple of last questions. These will be the last two that we'll take, but guys, continue to post questions and we'll respond to them via our website. Dave Jones asked a very good question because there was conflicting information and guidance on this initially. He said, we pay all our installers via 1099 and have 7 employees on W-2. Can we use both 1099 amounts and W-2 amounts to determine the amount of money we can apply for under PPP? We initially only use W-2 payroll amounts, which is far less than if we use both installer and W-2 salaries.
The simple answer is no, you can't use the 1099s. You can't use independent contractors. The confusion was this. They defined what was payroll costs. And they said the payroll cost was the sum of, and they listed all the items we've talked about before, healthcare, your salaries, your commissions, blah, 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 blah. They said, and A&D, payments to independent contractors, okay? However, the Small Business Administration has interpreted that A&D as an or. So what they're saying is that the definition for payroll costs for an employer is the first list of items, payroll costs, and the payroll cost for an independent contractor is his 1099s. That's how they did it. So the answer is initially, most banks, most people were saying, they don't make a lot of sense, but they look like you can include your 1099s, particularly since these independent contractors can themselves apply for a loan. And the Small Business Administration said, I'm going to clarify this, you can't include the 1099s. You're not allowed to.
Okay. Yeah, I remember that originally it seemed you could, and then they gave some clarity to that. A couple of other questions. My bank approved me for the PPP loan, but I've not received the money as of yet. Does that mean that although I've been approved, we really don't know the answer to this probably, there is no more money for government since I've not received the money yet?
Yes, we can answer that question because there may be is that all the money that's been approved adds up to the total amount available. Yeah, but it doesn't mean all the money that's been approved has been paid out yet. That I cannot tell you.
All right, and one more from Mark Weaver again. So some leases are gross, so they include real estate taxes. So why can't we take the taxes out on our net lease?
The fact of life is that your leases also require maintenance costs as well, most of these. So the answer is that if you pay your real estate tax separately, you're not allowed to include it. If you pay it as part of your lease, you are.
Good, good. That gives some clarity. Brett, thank you for your comment. Brett says that he was approved today and his bank says that he's getting the money even though he has not yet signed the documentation. So the approval apparently is what commits the money to that 350 billion, it looks like. Eddie, thank you very much for your comment. We plan on continuing to do this. Eddie's just thanking us for the continuing amazing information because it's unequaled in the flooring industry. We just want to help the industry as a whole. That's the reason we made our membership for primary members free. We want us all speaking with one voice in DC. I want to thank Jeff, Steve, Lewis, Free to State, who does our communication, and the teams that we work with. The whole entire WFCA team has been amazingly busy as our membership has really mushroomed during this time. We are here to help you. I think this is why associations exist. We are to meet needs, especially in times of crisis. So we're thankful to have the opportunity. We feel like we're kind of here for a reason just like this, and we will continue to update you as things change. Look for communications from us. But again, rather than waiting for information, I want to remind you, so much of this information is available to you at wfca.org. Also, we are very active on social media. So we've got Instagram, Facebook, LinkedIn, Twitter, all of those. If you need links to any of those, they're on the bottom right side of our homepage at wfca.org. We thank you all, and we will try again. Our intent is to do this every week to give you an update and help you better understand what is going on, and to do it in a Q&A format so you can get the answers that you need as we're going through. Again, Steve, Jeff, Lewis, thank you very much. God bless to everybody, and we look forward to talking to you again soon.
Stay safe, all.